Section 1:2 Introduction to Alpha. 1.2 Importance of Alpha. Alpha is a valuable measure in evaluating investment skill because it assesses the ability of a portfolio manager to generate returns above or below a benchmark, after accounting for the level of risk taken. Here are a few reasons why alpha is important in evaluating investment skill. Differentiates skill from market movements. Alpha helps separate the skill of a portfolio manager from general market movements. It provides a measure of the value added or subtracted by active investment decisions made by the manager. Positive alpha suggests that the manager's decisions have contributed to excess returns beyond what would be expected based on market movements alone. Assesses stock selection and timing. Alpha considers the specific investment decisions made by a portfolio manager, such as stock selection and timing of trades. It helps evaluate the manager's ability to identify undervalued securities or market opportunities and exploit them for potential outperformance. Measures risk-adjusted performance. Alpha takes into account the level of risk associated with an investment or portfolio. It evaluates whether the excess returns generated by the manager are commensurate with the amount of risk taken. Positive alpha achieved with lower risk indicates superior risk-adjusted performance. Guides investment manager selection, when evaluating investment managers or selecting funds. Alpha provides a useful metric to compare the performance of different managers against their respective benchmarks. It helps investors identify managers who consistently generate positive alpha and have a track record of outperforming their benchmarks. Supports active management assessment. Alpha is particularly relevant for actively managed funds or strategies, where the goal is to outperform the market or a benchmark. It helps investors gauge the effectiveness of active management by assessing the value added by the manager's investment decisions. However, it's important to note that alpha alone may not provide a comprehensive assessment of investment skill. It should be considered in conjunction with other metrics such as beta, standard deviation, and a manager's investment philosophy and process. Additionally, short-term fluctuations in alpha should be interpreted cautiously, as investment performance should be evaluated over longer time periods to account for market cycles and potential luck-based outcomes. Alpha plays a crucial role in identifying investment opportunities by helping investors assess the potential for outperformance and identify investments that offer attractive risk-adjusted returns. Here are some ways in which alpha contributes to identifying investment opportunities. Identifying skilled portfolio managers. Alpha allows investors to evaluate the historical performance of portfolio managers or investment strategies. By analyzing the alpha generated by different managers, investors can identify those with a track record of consistently outperforming their benchmarks. This can help in identifying skilled managers who have demonstrated the ability to identify attractive investment opportunities. Assessing active investment strategies. Alpha is particularly relevant in evaluating actively managed investment strategies. Investors can analyze the alpha generated by different strategies to understand their potential for outperformance. Positive alpha indicates that the strategy has historically been successful in generating excess returns, suggesting that it may continue to identify attractive investment opportunities in the future. Identifying mispriced securities. Alpha can help identify securities that are potentially mispriced in the market. Positive alpha implies that the portfolio manager has made investment decisions that resulted in higher returns than what would be expected based on the level of risk. This suggests that the manager may have identified undervalued securities or market inefficiencies, presenting investment opportunities for investors. Comparing investment options. Alpha provides a metric for comparing different investment options. By comparing the alpha generated by various investments or funds, investors can assess which options have historically offered better risk-adjusted returns. This allows for informed decision-making when selecting investments that have the potential for outperformance. Supporting investment research and due diligence. Alpha can serve as a starting point for further research and due diligence. When a particular investment or strategy exhibits positive alpha, investors can delve deeper to understand the underlying factors contributing to the outperformance. This may involve analyzing the manager's investment process, market insights, and risk management techniques to gain a better understanding of the investment opportunity. while alpha is a valuable tool in identifying investment opportunities, it should not be the sole factor considered. Other aspects such as the investment's risk profile, market conditions, the manager's expertise, and the alignment with an investor's goals and risk tolerance should also be evaluated comprehensively.